All right, let's dive into one of the wildest, most dramatic case studies in AI investing to come out of 2025. We're talking about a story with some incredible highs, some pretty painful lows, and most importantly, some really powerful lessons for anybody looking to navigate these markets. This isn't just theory, okay? This is a real breakdown of what happened to a company right at the heart of the AI.
So picture this. A brand new AI infrastructure company goes public, and the investor excitement is just completely off the charts. In just a matter of months, its stock doesn't just climb, it absolutely skyrockets, posting an incredible 367% gain from its IPO price. I mean, if you got it on day one, you were probably feeling like you just found the next big thing.
But the story never ends there, does it? Almost as fast as it shot up, the stock hit some serious turbulence. Before the year was even over, it had fallen more than 60% from that breathtaking peak. All that euphoria? It was replaced by a pretty harsh reality check, and it left a lot of investors scratching their heads wondering, what on earth just happened?
Okay, so let's pull back the curtain. The company at the center of all this chaos is CoreWeave. And in this explainer, we are not messing around with rumors or speculation. We're using verified market data to break down exactly what drove this insane roller coaster ride. And more importantly, we're going to distill all of that into clear, actionable lessons that you can actually use. So here's the game plan. First, we're going to deconstruct that explosive 367% surge. Then, we'll dig into the reasons behind the big 63% correction. And finally, we'll pull it all together into 4 crucial lessons you can take with you for your own strategy. Sound good? Let's do it.
All right, let's kick things off with the first part of the story. CoreWeave's incredible, almost unbelievable climb right after its IPO. We're going to look at what was basically a perfect storm of factors that sent this stock into the stratosphere.
And just look at the timeline here. It really shows you the sheer speed of this thing. CoreWeave goes public on March 27, 2025 at $40 a share. By the middle of the year, it hits a peak around $187. That is a 367% gain in just a few months. This wasn't a slow and steady climb, it was a straight-up market explosion, and it was fueled by this really powerful story about the future of AI that investors just could not resist.
So what was the fuel for this rocket ship? Well, it really boiled down to 4 key things. First, it had the ultimate stamp of approval, a big investment from NVIDIA, the undisputed king of AI chips. I mean, that's like getting a glowing recommendation from the biggest name in the game. Second, this wasn't just talk. CoreWeave had major public contracts with giants like OpenAI. Third, the company was reporting huge growth in its service backlog, which is basically future revenue that's already locked in. That gave investors a ton of confidence. And finally, you put all that together and you get some incredibly optimistic revenue projections from Wall Street. To the average investor, this thing looked like a sure bet.
But every rocket has to deal with gravity, right? So let's shift gears from that peak of excitement to the harsh dose of reality that came next. Because what goes up that fast, well, it often faces a correction. And CoreWeave was no exception. Let's dig into why the market suddenly slammed on the brakes.
And wow, this chart right here really shows you the reversal. You see that peak way up there at $187? By December, the stock was trading down in the high 60s. That's a drop of over 63%. Now, it's really important to remember that even at $68, it was still way up from its $40 IPO price. But for anyone who jumped in near the top, ouch. That was a really painful ride down. This chart just makes that drop feel very, very real. So what happened? It wasn't just one thing, it was a mix of factors. First, the whole market went through something analysts called capital expenditure digestion. Think of it like this. After a huge feast of spending on AI chips and servers, big tech companies kind of had to, take a breath and actually use all that new stuff before ordering more. Second, people started looking closer at CoreWeave's finances and got a little nervous about its high debt. Third, competition in their space started heating up from giants like Amazon and Google. And finally, more competition means you can't charge as much, which started squeezing their profit margins. Suddenly, that perfect story started to show a few cracks.
And this is a super important point. CoreWeave wasn't alone in facing these pressures. This slide puts it all into context. If you look at the other key picks and shovels suppliers in this AI gold rush, you see a bigger story. NVIDIA, the behemoth, still grew, but way slower. Vertiv, which makes cooling systems, stayed strong. But Supermicro, a server maker, faced serious margin pressure, just like CoreWeave. You see, this shows it was a sector-wide reevaluation, not just a problem with one company.
Okay, so what can we actually learn from all of this? This whole story isn't just about looking back at 2025. It's a powerful case study, and it is packed with clear, actionable lessons for the future. So let's pivot to the 4 most important things you can apply to your own investment strategy.
All right, let's break these down. Lesson 1. Cycle timing matters. The CoreWeave story proves that the biggest, fastest gains often happen super early in a new tech buildup. The people who got in at the $40 IPO saw that firsthand. Lesson 2. Follow the contracts, not just the hype. Yeah, the initial surge was fueled by hype and real contracts, but the correction came when the market started to worry if that growth was sustainable. Real, verified backlogs matter way more than flashy headlines. Lesson 3. Diversify. Instead of betting the farm on just one company, a smarter move might be spreading your investment across those different picks and shovels we saw: the GPUs, the servers, the cooling. And finally, lesson 4. Be patient. You don't have to buy everything at once. Instead of FOMOing in at the peak, you can use tools like dollar cost averaging to build a position slowly over time.
Look, if you forget everything else from this explainer, just remember this one thing. All 4 of those lessons really boil down to a single idea. In a market that's constantly swinging between hype and fear, the most powerful tool you have is data-driven patience. It helps you buy logically and stops you from panic selling when things get choppy.
So I'll leave you with this question as we look ahead. When a market gets hot, it is so easy to get swept up in a great story and a stock chart that's going straight to the moon. It's much harder, but usually way more rewarding, to be the person who actually digs into the data, who focuses on the real numbers, and who makes decisions based on contracts, not just hype. The choice, as always, is yours.